This is not normal trading anymore. What hit the market was not a routine pullback, not a healthy correction, and not just another noisy headline cycle. War risk surged, oil reacted instantly, and silver stopped behaving like a sleepy industrial metal. In one move, three separate stories fused into a single market event. And when that happens, prices do not just move, they reprice reality. That is what this video is about. What changed, why it matters, and why most people are still looking at the wrong chart. Because if you are only watching silver in isolation, you are already behind. If you are only watching oil as an energy story, you are missing the cross-current. And if you think war headlines are just emotional noise that fade in 24 hours, you are underestimating how quickly modern markets can move from complacency to panic. The shift is already happening. Quietly at first, then all at once. What happened is simple on the surface and dangerous underneath. Geopolitical tensions spiked. Energy markets immediately began pricing in supply disruption risk. Capital rotated into protection. Safe haven flows woke up. Industrial input fears started creeping higher. And silver, which sits in a strange place between monetary metal and industrial necessity, suddenly found itself at the center of both stories at the same time. That is the part people are not fully processing yet. Normally, traders like clean categories. Oil belongs in one box, gold belongs in another. Silver gets treated like the awkward cousin stuck between inflation hedge, industrial metal, and speculative trade. But war does not respect those categories. When conflict risk collides with the energy complex, the entire pricing structure of the market begins to distort. Transportation costs matter more. Manufacturing margins tighten. Inflation expectations become unstable. Rate cut assumptions get questioned. Safe haven demand rises. And silver gets pulled by all of it at once. That is why this is not normal trading. In a normal market, you can explain a silver move with one or two familiar drivers. Dollar up, silver down. Yields up, metals weak. Manufacturing optimism strong, industrial demand improves. But when war risk and oil spikes enter the system together, silver stops acting like a one-variable instrument. It becomes a pressure gauge for multiple fears at the same time. Inflation fear, supply chain fear, currency fear, growth fear, policy error fear. And that is when price action starts looking irrational to anyone still using a normal market playbook. Look at how this sequence usually unfolds. First, conflict risk appears as a headline. Many traders dismiss it. Then oil jumps. That gets attention because oil is immediate. It feeds into transport, production, food, shipping, power, confidence, everything. Then equity traders start asking whether higher energy costs will squeeze earnings. Bond traders start questioning whether inflation is really going away. Central banks suddenly look less flexible. And somewhere in that chain, metals wake up. Gold tends to get the first safe haven bid. But silver is the one that can become explosive when both fear and scarcity narratives start overlapping. That overlap is the key. Silver is not just a crisis asset. It is also a material the modern economy actually uses. Electronics need it. Solar systems need it. Industrial manufacturing leans on it. Advanced energy infrastructure leans on it. So when the world gets more unstable and more expensive at the same time, silver can get hit from both sides. Investors want protection. Industry still needs ounces. And supply does not magically expand just because the chart gets exciting. That is where the setup changes from interesting to serious. Most people still do not appreciate how fragile commodity pricing becomes when energy is involved. Oil is not just another market. Oil is the bloodstream. When oil moves violently on geopolitical risk, it does not stay in its lane. It changes freight costs, mining economics, smelting margins, shipping insurance, refinery assumptions, and input costs across the entire system. So even if silver demand stayed flat, higher oil could still alter silver's cost structure. But demand is not flat. That is what makes this different. And here is what the average viewer is missing. They see a war headline and assume it creates temporary emotion. They see oil move and assume that is the main event. They see silver spike and assume it is just retail speculation or algorithmic noise. But the deeper story is that war risk can turn a market from efficiency pricing into security pricing. That sounds technical, but it matters. Efficiency pricing asks, what is the fair value in a stable, functioning system? Security pricing asks, what will I pay to guarantee access if the system stops functioning smoothly? Those are not the same question. And security pricing always leads to more violent moves because buyers stop optimizing for cheapness and start optimizing for certainty. Once that transition begins, markets get weird fast. Think about what happens when participants start worrying less about spot price and more about future availability. Producers become slower to sell. Buyers become quicker to lock in supply. Traders who were comfortably short become less comfortable. Inventories that looked adequate suddenly look thin. Spreads widen. Volatility increases. Headlines start feeling bigger because the market structure underneath them is weaker than people assumed. That is how a normal commodity becomes a strategic one in the eyes of the market. Silver is especially vulnerable to that shift because it is too important to ignore and too small to absorb panic cleanly. Gold is larger, deeper, more universally understood. Oil is mission critical and constantly watched. Silver lives in that dangerous middle ground where it is essential enough to matter, but underfollowed enough that when the market wakes up, the adjustment can be violent. That is why silver rarely moves in a calm, linear fashion when the story changes. It lurches, it gaps, it traps people, then it forces them to chase. And if war keeps energy elevated, the silver story gets more complicated, not less. Because now you have to ask uncomfortable questions. What happens to industrial demand if energy costs rise, but governments still push electrification? What happens if inflation proves sticky at exactly the moment growth begins to soften? What happens if central banks want easier policy, but commodity pressure keeps the inflation narrative alive? What happens if investors realize silver is not just a trade on optimism anymore, but also a hedge against disorder? Those questions do not have neat answers. They create repricing. This is where the hidden risk enters the picture. The risk is not only that markets become more volatile, the risk is that the old relationships stop working just when traders rely on them the most. Maybe yields rise and silver still holds. Maybe the dollar firms but metals do not fully break. Maybe equities wobble, oil stays bid, and silver refuses to behave like a simple industrial metal. Those are the kinds of signals that tell you the market is no longer trading the old script. It is writing a new one in real time. That is why blindly fading these moves can be dangerous. In stable periods, many traders get rewarded for selling fear. They short spikes, fade headlines, assume normalization. Most of the time that works because most headlines do fade. But when a move is tied to war, energy, and monetary uncertainty all at once, fading strength can become a very expensive habit. The market may not be reacting to the headline itself. It may be reacting to the implications of what that headline does to energy, inflation, supply chains, and policy expectations over the next several months. And that is a different game entirely. Now step back and look at oil's role in all this. Oil does not need a full-blown supply collapse to change everything. Sometimes the threat alone is enough. The market only needs to believe that transit routes are less secure, production assets are more vulnerable, or regional escalation could tighten flows. Once that belief takes root, even temporarily, it starts changing calculations everywhere else. Inflation models adjust, input assumptions change, corporate planning gets more cautious, consumers feel it, governments feel it, central bankers definitely feel it. That is why oil is never just oil during geopolitical stress. It becomes a transmitter. And silver, strangely enough, is one of the assets most likely to reflect that transmission in a non-linear way. If energy costs rise, industrial production costs rise. If inflation expectations rise, precious metals become more relevant. If safe haven demand rises, silver gets another tailwind. If policy credibility weakens, that tailwind gets stronger. If growth fears emerge, silver can wobble because of its industrial side. But if monetary fear dominates, it can rip higher again. That internal tug-of-war is exactly why the chart starts looking so unstable. It is pricing multiple futures at once. One future says conflict cools, oil retraces, inflation softens, and silver calms down. Another says energy stays high, policy gets boxed in, risk appetite weakens, and silver becomes more attractive as a hybrid hedge. A third says the market starts worrying about actual availability and cost pressure across strategic inputs, and silver gets dragged into a much bigger resource story. That third path is the one very few people are ready for. Because once the market begins treating a metal as strategically relevant during a period of geopolitical instability, the conversation changes from, is it overbought? To, who still needs this regardless of price? That question matters far more than most technical indicators in moments like this. Industry may need silver even if traders get nervous. Investors may want silver even if stocks bounce. Governments may continue pushing infrastructure that depends on silver even if energy remains expensive. Those layers of demand do not disappear just because the market gets crowded for a few sessions. And remember, normal trading depends on trust. Trust that supply chains function. Trust that energy flows continue. Trust that inflation pressure stays contained. Trust that central banks have room to maneuver. Trust that volatility can be sold and absorbed. War chips away at all of that. Oil accelerates the damage. Silver reacts not just because of what it is, but because of what it represents when trust starts breaking down. This is why the move feels bigger than the headlines, because it is. It is not just about one conflict flare-up. It is about what happens when the market suddenly realizes that the era of frictionless assumptions may be over. Cheap energy assumptions, predictable disinflation assumptions, stable shipping assumptions, smooth policy assumptions. Those were the foundations of calm pricing. Take away even 2 or 3 of them, and the market no longer has a clean anchor. That is when assets like silver begin to matter more than people expect. Now let's talk about the psychological side, because this is where a lot of people lose the plot. When markets stop trading normally, people crave certainty. They want one headline to explain everything. They want one expert to say exactly what happens next. They want simple cause and effect. But this kind of setup does not offer that. It offers pressure, feedback loops, and fast repricing. That uncertainty is precisely why strong trends can last longer than rational people think. The first crowd says this is all temporary. The second crowd says this is the start of something much larger. The dangerous part is that both crowds can look right for a while. That creates whiplash. A retracement convinces people the move is over. Another oil spike revives the fear. Silver pulls back, then surges. Commentators call it confusion. It is not confusion. It is transition. The market is trying to decide whether this is a shock to trade or a change in regime. And regime changes are rarely obvious on day one. They become clear only after the market has already moved far enough to punish anyone waiting for perfect confirmation. That is why watching silver right now is so important. Silver tends to expose stress before the broader narrative gets cleaned up for mainstream audiences. It reacts to industrial pressure before economists update their elegant forecasts. It reacts to monetary anxiety before policymakers admit constraints. It reacts to fear before the average investor understands why the old playbook stopped working. Silver's volatility is not a flaw in moments like this. It is information. So what should you actually take away from all this? First, the market is no longer trading one story. It is trading an intersection: war, oil, inflation risk, and strategic materials. Second, silver is one of the few assets sitting directly in that intersection. Third, when that happens, price action becomes more unstable, but also more meaningful. Big moves are not automatically fake. Pullbacks are not automatically healthy. Breakouts are not automatically irrational. The context matters more than ever. And the context says something changed. What changed is that energy risk is back in the driver's seat, geopolitical premium is back in the system, and silver is no longer being evaluated only through the narrow lens of industrial optimism or precious metal sentiment. It is being evaluated through the lens of systemic stress. That is a much bigger lens. And once markets make that shift, they do not always reverse neatly. Could tensions cool? Absolutely. Could oil retrace? Yes. Could silver pull back hard and shake out weak hands? Of course. But even that would not erase what the market just learned. It learned that war can still shock pricing fast. It learned that oil remains the transmission mechanism. And it learned that silver does not need a perfect economic boom to matter. Disorder can matter just as much. That realization is powerful, because it means the upside case for silver is no longer dependent on one clean macro narrative. It does not need everything to be bullish at once. It can feed on instability, inflation anxiety, strategic demand, and policy uncertainty all together. That makes it harder to dismiss and harder to model. It also makes it more dangerous to underestimate. If you are waiting for this market to feel comfortable before taking it seriously, you may be waiting far too long. Comfortable markets do not announce regime shifts politely. They force recognition through price. That is what this moment looks like. Not a tidy rotation, not a random spike. A warning shot that the market may be moving from complacency pricing to conflict pricing. And once conflict pricing takes hold, everything starts trading differently. Oil matters more. Metals matter more. Inflation matters more. Policy mistakes matter more. Supply chains matter more. And silver, sitting right in the middle of all those fault lines, becomes one of the clearest signals that the world is not trading under normal conditions anymore. That is the real story here. Not just that war happened, not just that oil moved, not just that silver reacted. It is that all three linked up in a way the market cannot casually ignore. A system built on stability just got reminded how quickly instability can return. And when that reminder hits commodities, currencies, and investor psychology at the same time, price is not just reacting, price is revealing. So no, this is not normal trading. Normal trading does not make one geopolitical shock ripple through energy, inflation, industrial metals, and safe haven demand all at once. Normal trading does not force silver to act like both a fear asset and a resource asset in the same move. Normal trading does not make the market question whether it is pricing efficiency or pricing security. This is bigger than a headline cycle, bigger than a one-day oil spike, bigger than one silver breakout. This is what the early phase of a market regime shift feels like. Messy, fast, doubted, and deeply important. Watch the oil market. Watch silver's reaction to every retracement. Watch whether fear cools or hardens into repricing. Because the next move will not just tell you where metals are going, it will tell you whether the market believes this shock is passing, or whether it just changed the rules. And if it changed the rules, then the biggest mistake investors can make right now is treating this like just another ordinary trading day. If you think the market is still underestimating where this could go, drop your view in the comments. Do you see this as a short-term war premium, or the beginning of a much bigger repricing in oil and silver? And if you want more high-conviction finance breakdowns like this, subscribe now, because this story is moving fast, and the next phase could be even bigger than the first.